So with that, again, my name is Max, founder of Hi. Hope you're enjoying your Friday. I'm a founder and principal of SORBUS Advisors, a valuation advisory firm. We specialize in fair value, anything and everything that your auditors will ask you to produce for the purposes of your financial statements. Bulk of our work is purchase price allocation work, valuation of intangible assets, and other elements of transactions. We also do a substantial amount of work in 409A valuations, as well as financial instruments and portfolio valuations. We also assist companies in strategic transaction pricing and quality of earnings studies. So with this, I will minimize my screen and we'll go over to the presentation. So flipping through the first couple of slides. So what we'll talk today is first, I'll define the purchase price allocation and what that means in terms of valuation analysis. We'll talk about what's being valued, the overall process of the valuation. We'll talk about the intangible assets and briefly touch upon earnouts. And then we'll finish this webinar with talking about strategic meaning of this analysis for your future acquisitions, as well as how the subsequent accounting will be related to this purchase price allocation analysis. So first, a show of hands, who has done purchase price allocations before or been part of the purchase price allocation project? Again, the button is on the top left of your screen. Okay, so actually not that many people. And so that's great. Be happy to sort of introduce you guys to the wonderful world of purchase price allocations. Purchase accounting is a process of allocating acquired assets and liabilities after M&A transaction on the acquirer's balance sheet. There are obviously specific regulations or GAAP requirements for doing that, and the section of the accounting standard codification, or rather topic 805, covers this. Typically, in a purchase price allocation, one of the biggest concerns is the valuation of the intangible assets and earnouts acquired. And so that's where the process of purchase price allocation, which in itself is an accounting exercise, and so really the final say for this comes from CPAs, but the valuation specialist plays a very important part, because valuation specialists provide some of the bigger numbers that will appear on the balance sheets of the acquirer. One thing to keep in mind here is that the process of purchase price allocation, especially when it relates to intangible assets, is really a greenfield type research and discovery on our part as to what intangibles were acquired and how to value them and valuing those intangibles. It's not a process of adjusting existing entries, and quite frankly, what's on the balance sheet as far as intangible assets and goodwill concern after the acquisition is irrelevant. What's relevant is this brand new analysis that will be performed by your valuation specialist. Now, I'll open up for a polling question real quick here, and this question is about who cannot perform the fair value analysis for those purposes. All right, getting some answers in. Interesting. So again, great. Audit firm is the entity that cannot perform this analysis for their audit clients, I have to mention. So the process of the audit is really a process of reviewing somebody else's numbers. The audit firm cannot be reviewing its own numbers. Management can absolutely do this analysis in theory. I say in theory because the process, as you will see from this presentation, is pretty esoteric, and it's a very tightly prescribed approach that you have to follow here, and we obviously do it all day long, and even that sometimes not enough for the auditors who review the work. I mean, you'll hear two large firms going at it in the review of the purchase price allocation work, with both firms being fully committed to the practice of that. Summer intern, again, let's imagine it's a summer intern who is changing jobs and in prior life worked in valuation industry. So for example, if I, a couple of years from now, decide to take a summer intern job and switch gears, so to speak, then I could certainly be performing that work for my new employer. So again, audit firm is the only entity that cannot do this analysis. So what's being valued? In theory, everything. So the balance sheet that you adapt from that acquired entity has to arrive over on the acquirer's balance sheet at fair value. Granted that some items of that balance sheet don't require very deep analysis for that purpose, let's say cash, right? We know cash is cash, and other elements of tangible assets. But typically the issue again arises when there is a substantial amount of premium paid over book value of the entity, and that represents what's called excess consideration, and that's typically intangible assets. So technology, customer relationship, contracts, trade names have to be valued. Earnouts is another area, and this is actually a liability that you will place on your balance sheet if you allowed for an earnout in your purchase agreement. That also has to be valued and not straightforward. We'll talk about it. Depending on what you're acquiring, inventory and fixed assets may require a brand new greenfield approach to the valuation. Leaseholds and deferred revenue, those things are also valued, although both of those items will be changing in the next couple of years. Again, valuation will still be required, but it will look different because of the new lease standards and revenue recognition standards. Portfolios and non-operating assets, all that has to arrive at fair value. And here, one thing to keep in mind is that somebody who knows how to develop technology doesn't necessarily know how to value the portfolio of credit instruments. So at SORBUS Advisors here, we specialize in going across the board, and so we can cover everything what's on this slide right now, but we'd like to believe it's not frequent that you find this, and so it's very important for you to really know that the person who is doing your purchase price allocation has experience in purchase price allocations and not, say, in 409A valuations. So as I mentioned before, there's really a very tight prescription as to how to do the purchase price allocation work. It is an allocation, and so we really start with analyzing the overall transaction. We'll look at the purchase price and the financial forecast, and we actually start by determining the implied rate of return or investment return that company is expecting to receive as part of this acquisition, as part of this valuation. And so with that, we start the analysis. Actually doesn't have anything to do with intangibles at this point, and it's a substantial piece. After that, we do go into intangibles. First, we have to identify intangibles that need to be separated and recognized apart from goodwill, following ASC 805 requirements for it. We value those intangibles. We may value, as I mentioned, other elements of the balance sheet depending on what needs to be fair valued. And at the end of this process, we determine what the goodwill, residual goodwill is. Now, we don't value goodwill separately. Goodwill is typically what's left after you take the purchase price and subtract all the assets and liabilities that were acquired. There were models with some firms where they do try to value goodwill separately, but really it's not a very meaningful valuation, because goodwill is just a residual and kind of everything what's not identified. Now, the valuation work, see, I'm still staying on the slide, but valuation work may really start often with determining purchase consideration. So when it's cash, it's easy, but when the company paid for the acquisition with their own stock, it's easy only if you're dealing with public company that makes an acquisition. If the private company makes an acquisition, then you have to really pay attention and try to determine what the value of that shares are. Now, a lot of times we see in purchase agreements, there is a notional amount attached to the shares, and most of the time that number is not usable, it's not applicable. The first place to look for is the 498 report, but that 498 report would have to be contemporaneous and it would have to be substantive. So it cannot be sort of back of the envelope OPM analysis, but it would have to have something that has discounted cash flow analysis and such. The 498 report does not have to be on the same date as the date of the acquisition. So you can, within the reason, extrapolate those 498 valuation reports. Now, earnout is another one that requires valuation, and it's a whole separate topic. Assumed liabilities, that's another area where you have to be careful about whether you can just bring assumed liability at book value or it requires some kind of valuation as well. And so purchase consideration may be a substantial piece of what your valuation specialist has to do for you. So definitely make sure that this type of stuff is communicated on one hand. On the other hand, make sure that your valuation specialist is asking those questions. Now, I mentioned that opening act of this process really is the internal rate of return analysis. And internal rate of return analysis is the one that shows us what economic investment return acquirer expects from this acquisition. Now, it's sort of a reverse valuation in some ways, because we have a forecast, but we also have a purchase price. And so we find that discount rate that would allow our financial forecast support that purchase price. Now, this number is important in several ways. So first of all, this number is important because it is indicative of whether transaction was priced at fair value. If this number is too high, then there is a possibility that your auditors might determine it was a bargain purchase. In other words, you paid for too little for the company, which is obviously not a problem for you in strategic terms, but in accounting, bargain purchase will lead to certain accounting, or may lead to certain accounting adjustments. On the other hand, if this number is too low, then the return is too low. And so essentially you paid too much for this acquisition. That's not a good strategic answer. Obviously, nobody wants to pay too much. So this is something, again, to kind of keep an eye on. But in the process of purchase price allocation, you really have to be able to support this number, this 30.5% number. You have to be able to support it with some independent market indicators of the cost of capital of the target, not of the acquirer. So big difference there. And so if we cannot support that number, then we either have to scrutinize the forecast or we have to scrutinize the purchase price. This is actually a great process that leads us into the next slide about financial forecast, which has to satisfy certain specific requirements. So financial forecast typically takes a center stage in this analysis, in the purchase price allocation analysis. Regardless of whether you prepared one for your acquisition or not, there has to be a good and robust financial forecast. If there is no forecast, then you would have to create one for the purposes of the purchase price allocation. But here we quite honestly, we can talk about financial forecast for the whole hour. It's really a big subject matter that we deal extensively with. But so first of all, here we'll introduce this whole concept of market participant. So market participant is the view that you have to take when you're creating that forecast. In other words, imagine that you're a strategic acquirer, but everybody else, let's say 5 other bidders, were private equity firms. Now you have to build a forecast that would actually reflect the view of the market participant or those other private equity firms. You cannot include, or obviously depends on facts and circumstances, but most of the time you would not be able here to include your strategic synergies that you expect from this acquisition. So in the process of developing financial forecast and working through this project, you have to identify or document people or entities who submitted a bid or participated in trying to buy the target. And if there was nobody else, then you have to create a list of hypothetical purchasers of the target. Now, synergies, following on what I just said about synergies, a synergy has to be a market participant synergy. It cannot be acquirer-specific synergy. So if you have some kind of obscure reason to save a lot of costs on this combination that would not be available to anybody else out there, then you cannot include the synergy in the forecast. Now, the forecast itself has to represent a reasonably optimistic expectation of the performance of the target. It cannot be seller forecast because those typically just don't make a lot of sense. It cannot be too conservative either, because if it's too conservative, then your implied rate of return from the prior page would be too low and would not be able to support this forecast. The more detail you provide in the forecast, the better. So the assumptions and drivers behind, revenue growth, costs, and things of that nature, any kind of market research that you can bring into this process would be very helpful as well. And the profitability of the forecast has to be commensurate with the probability of publicly traded companies in the out years, obviously not right away. But when we take this forecast out, and the forecast, I didn't mention that, but ideal forecast would be at least 5 years long. And so once you get in those out years, your profitability has to migrate towards the market participant or publicly traded company indicators. The last point here, and actually very important, is the forecast has to be fully burdened with all the corporate overheads. A lot of times we see the forecast that is incremental. In other words, it does not include all the costs that are typically assumed by or incurred by the buyer, but all that has to be included. So in this point, let me start the second polling question. I'm going to launch it. And so essentially, stock-based compensation expense, does this have to be included in the forecast or not? All right, so starting to get some answers here. Yes, so the stock-based compensation is not a cash item. And so therefore, people tend to think that if it's not a cash item, let's not include it anywhere. And so that's how adjusted EBITDA reported to the investors, and that's how they think about their cash flow forecast. The problem here is that stock-based compensation is not like depreciation. So when you have depreciation and you're adjusting for that in EBITDA calculation, to get to the free cash flows, you also have to subtract capital expenditures. And so you actually have this interplay between depreciation and capital expenditures, which reallocates cash flow in different reporting period, but it doesn't really get rid of it in any way. It doesn't get rid of that expense. In stock-based compensation is actually a perfect little number that is a present value of your future cash outflows as they relate to future payments of the stock options that are in the money. So stock-based compensation is a valuation of that little element of your company that you gave away. And so it's on the fair value basis on the date that you incur those expenses. And so that has to absolutely be subtracted or incorporated into your forecast. Now, let's talk about the intangible assets here a little bit, since intangible asset would be the principal and main reason to do this. So intangible assets, first of all, how they defined. The intangible is a really bad adjective for this because intangible, when we kind of grow up and take our first lessons from the teacher, we think intangible is something very abstract and something that, we're not quite sure what it is, but it seemed to be there. So intangible, but in the context of purchase price allocation, intangible assets are very tangible. So we don't value things that corporate culture, and we don't value things like customer loyalty, although it may somehow be included or incorporated, but not separated from everything else. What we value under ASC 805 is something that's separable from the entity and something that has contractual or legal rights attached to it. So when we think about the software code is very clearly, it's visible. You can see it, you can analyze it, you can estimate how much effort would it take to build it. So it's almost like a physical infrastructure, except for it's not, a three-dimensional thing that you can walk around and touch. But everything else about software is very, very tangible. The same thing, the contracts, the same thing about works of art or copyrights, the same thing about customer relationships or backlog. All those things can be documented, and they're very specific, and that's what we value. So let's go into the first type valuation analysis for intangible assets. Now, the valuation techniques for whatever you value actually out there, doesn't matter if it's intangible or businesses or what have you, derivatives, they separate it into three basic approaches. It's the income-based approach, it's market-based approach, and a cost-based approach. The income-based approach is the one that looks at the future cash flows and determines what's the present value of this future cash flows. In other words, what the income stream can you generate from this particular asset. The second one is the market approach, where you're essentially saying, well, you have X number of dollars in revenue, so the multiple would be Y, and so we just do the simple multiplication to get to the value of that asset. And the third one is the cost approach, where we're saying, well, something is worth as much as it costs to develop it, because we can always build it ourselves. And the income approach is always, first of all, it's used a lot more frequently in intangible asset context because there's not as much comparable market data that you can use for things like technology or contracts. It just, things are not as comparable and always very different one from another. The market approach can be used for things like content library, for example, or library of various works like movie library or what have you. Cost approach is also used quite often for companies that are not very far into their development, and it's usually easier to track how much effort was invested in a particular intangible asset. So here you see multi-period excess earnings method. So this is sort of the king of valuation methods. It's you can think about it as DCF on steroids. So essentially what we do here, we start with that financial forecast that we had for all of the company, the whole company. And we carve the part of the forecast out that can be attributed to one particular intangible that we're trying to value. So in this case, you'll see that you have a revenue line at the very top, and that's the total business revenue line. So it's a total business revenue line. Now, revenue migration is something that the migration or percentage attribution of that future revenue to the current set of intangibles that were acquired. So imagine this is a customer relationship valuation and you have 80% customer retention rate. So what we're saying here is in 2017, only 80% of all of the revenues will come from the customers that were here on the acquisition date. And so from there, we kind of go out in the future using that 80% attrition rate. You'll see that the attribution drops over time, and so retained revenue drops over time. Now, we use that retained revenue as basis for our valuation going forward. Now, operating expenses are typically attributed purely based on percent of revenue as the overall company forecast. However, there might be adjustments there. And the operating income would be affected with tax. So taxes would be subtracted from the operating income, and we would get to the net income. So net income is really an accounting type measure that would tell you how much of that accounting income you derive from the asset that you're trying to value. Now, in addition to that, there is one more adjustment that we have to make, and it's the subtraction of contributory asset charges. So in this case, we're looking at the contributory assets that are trade names. And when we say common assets, those are typically a trio of net working capital, fixed assets, and workforce. So those four contributory assets, they participate and help this, say, customer relationship asset to be monetized. So you need to have a trade name and you need to have those common assets to be able to monetize the trade name. And so because you need those assets, you need to pay rent for using those assets. And so that's the theory behind making those additional reductions to the accounting profit from that particular asset for the attribution of other intangible or tangible assets that we need here. Now, those contributor asset charges are different from expenses. So you absolutely have to still pay your employees, and that's in the operating expenses. But when we're talking about charging for, say, workforce, this is really an economic return separate from the maintenance that is operating expense. So you can also think about it as, you know, when you're paying off the loan, right? Like part of it is principal and part of it is interest. So the interest part is what really goes into the contributory asset charges, and principal is the operating expenses. Now, once we get to the after-tax cash flows, that's what needs to be discounted. And the discount rate is typically determined based on that implied rate of return number. So it doesn't have to be exactly the same number, but it has to measure somehow against that implied rate of return. So if we're saying that this intangible asset is generally more risky than overall entity, then we'll adjust this discount rate upward. And if we say it's less risky, then we'll adjust it downward. Typically, people like to see intangible asset risk to be higher than the overall entity, and that works if you have a company with a lot of physical assets. But if you have a technology-based company, then a lot of times, this discount rate, it really compares to the discount rate you would attribute to the goodwill, and goodwill is a lot more ambiguous than the specific intangible that we're trying to value. So you will see the adjustment downward from the overall target cost of capital. By the way, I'll just stop here, and certainly feel free to ask a question. It's on the top left corner. I will get to the questions after I finish the presentation. So the next approach, also a very common approach called relief from royalty method. It's also an income approach. And what this method does, it really measures the amount of benefit you get by not having to in-license the asset that you need to sell your product. So if you have a very valuable trade name, or if you have a certain technology and you use this trade name or use your technology in selling, when selling your product, then say you're Coca-Cola, right? You don't have to in-license Pepsi name, but you can use your own Coca-Cola name to sell your product. And so the savings that you get from not having to in-license the name is what we actually measure here. So that's why it's called relief from royalty. Now, a revenue forecast becomes important here. So we start with the revenue that would be attributed to the product that benefits from your trade name or that benefits from that technology. So it doesn't have to be all of the revenue. And we also have to find some way to sunset those numbers, because if you have a life, in other words, if this asset, you don't expect it to exist forever, then would have to find the life of that asset. Typically, that is done through due diligence work with management. We'll have to determine what that representative royalty would be if you were to in-license this asset. And then you measure the amount of cash that you're saving from it. It's obviously pre-tax expense, so you take an after-tax income here, and you discount that again at the discount rate that is related to internal rate of return, but maybe higher or lower depending on what the facts and circumstances are. I'll kind of pause here for a second and really mention here that even though those exhibits seem to be self-contained, you might have 3 or 4 intangible assets valued for the purposes of purchase price allocation, and you'll get a 70-page report from your valuation specialist. Now, those 70 pages are not fluff. A lot of them really have to do with how you support those assumptions. Because as you can see, those revenue adjustments or the royalty rates or the discount rates, all that is extremely and highly subjective. And so the large focus right now, especially in the audit community, is how you support those numbers. While we certainly understand that management has a very good understanding and feel for what those numbers might be, auditors are auditors, and so they need to make sure that those assumptions came to independently. For publicly traded companies, there is often a tendency to try to understate the value of the intangible assets because there will be less amortization in their earnings per share. And so that's kind of one level of scrutiny that you would typically receive from the auditor if you're a publicly traded company. Now, moving on to the last one, cost approach. I'm not going to talk too long about the cost approach, but essentially it's where, as I said earlier, you looking for the whether you want to build or buy something, right? And so you would say, okay, this intangible asset is worth what it takes to build this asset. Now, this approach is not very popular with intangible assets because there's a view that it may significantly understate the value of the intangible, especially if the intangible turns into something very successful. But what's also surprising about this is that typically the valuation will end up with a number that's greater than the sum of all your expenses related to developing this asset. And that's even after you account for a certain amount of obsolescence related to those expenses. The reason for that is we have to add 3 pretty significant numbers here into this analysis. First of all, we have to have a future value factor. It's a sort of reverse present value factor. If we invest $100 in 2013, we'd like to have, say, $150 in 2015 after that investment. If you end up with $100, then you would be better off investing in treasury bonds. So in other words, there is an economic return that you expect from every dollar that you put in any kind of venture. Now you have to account for corporate overhead, and you also have to give it a business profit. That's a separate element. It's not an economic return, but it really accounts for the fact that we're in business of making money, and so if you spend $1, you want to get if you spend $100, you want to get $120 back. So there has to be business profit. So those three factors can be rather significant, especially that future value factor, especially in the small companies. And so this is something to kind of keep in mind and not be too surprised when the number comes at higher. So this is sort of the summary of all the methods. Multi-period access earnings method is the most desirable method and typically reserved for the largest intangible asset that was recognized in the acquisition. Revenue from royalty is sort of a good workforce, but in certain industries it really doesn't work or break down. For example, in software technology, really a bad method to use because there is not a good consensus out there and very difficult to determine that royalty rate. It's just not how they do business. But say in medical devices, that's what they do. Cost approach can be used across the board, but again, it's not the most desirable one and typically reserved for intangibles that are either smaller or the company is very young. Without method is commonly reserved for non-compete agreements. And so essentially this is where you compare your cash flows from two scenarios. One is that the person competes, and one where the person doesn't compete. And so the delta is the value of that non-compete agreement. Now, non-compete agreements are pretty small usually in value in the purchase price allocation world, but without method is extremely valuable in a corporate planning world or strategic planning world for companies. So like brand names could be valued based on the without method, or technologies could be valued on without method. It's typically pretty laborious and is not really warranted for purchase price allocation world, but certainly internally companies do a lot of that. So last part that we'll mention as far as things that get valued is the earnout. So the earnout or contingent consideration has to be recognized on the balance sheet as a liability, and it then has to be marked to fair value as a company progresses through the fulfillment stage or ultimately gets resolved or written off. Now, contingent consideration may or may not be pretty complex. Depending on what kind of conditions are attached to that non-compete agreement, different methodologies apply. Now, the Appraiser Foundation issued a draft as to how to approach this actually a couple months ago, very recently. And it introduced a number of methods that are actually option-based methods that help cut through the subjectivity in a very significant and very helpful way. Now, typically people used to think about earnout as, it's a simple scenario analysis, right? Like if the company hits a certain revenue threshold, they get paid X million dollars, and so we'll just, multiply it by probability of that occurrence taking place and then discounting it to the present. Now, while this approach would be very intuitive, the assumptions that you have to apply here are extremely hard to come by. So both probability and the discount rate are absolutely very difficult to support if you're guessing them. So the probabilities, imagine developing a probability for your stock option to be in the money. That's essentially what you're trying to do. And so even though management or whoever works on the project can come up with their own feel or subjective judgment about it, it typically triggers a lot of back and forth with auditors. And auditors, they just need numbers to kind of tie and and check. And when it's just a subjective guess, then this process can go in circles for quite a long time. Discount rates are also not intuitive at all. When discount rates were tested in a situation such as stock options, and when stock options were valued using this sort of scenario approach, discount rates could go from 0 to 100. Or actually into hundreds. So there's, and that obviously affects the value in a substantial way. So again, what Appraiser Foundation has done here, they really helped to work through the situations where the earnout is some kind of contingency or threshold situation where we can substitute the option-based model, or I'm sorry, we can use the option-based model to substitute the scenario analysis. Scenario analysis will still work when you deal with milestones that are technical, that are things that don't correlate with the market, like, for example, the likelihood of certain drug being approved by FDA. So that's not a financial milestone, it's a technical milestone. And so their probabilities would still work. But anytime you have the earnout that's based on revenue threshold or EBITDA threshold, or maybe both or a combination of those, agreements can be pretty complex. Then option pricing methodologies or even simulations of multiple scenarios with Monte Carlo methods might have to be applied. So let's talk about purchase price allocation impact on the world sort of outside of the purchase accounting. Again, purchase accounting seemed to be pretty, contained, right? You acquire the company, you have to adopt a new balance sheet, so you go through the process. So what's next? So there are several areas where the purchase price allocation remains relevant, and that analysis remains relevant from the accounting standpoint. So we're only talking about accounting right now, right? And so the first place to look, of course, is impairment studies. Now, every time you deal with any kind of intangible that has indefinite life, and that could be in process research and development, it could be trademark, it could be goodwill. Well, goodwill is always, and IPR&D are always indefinite life intangibles. So those have to be tested for impairment periodically. And so there is a way to shortcut the process of testing. If the company is doing well and everything is moving along as planned, then so-called step 0 would allow you to simply draft a memo for your auditor and say, hey, things are doing well. We looked at this, that, and the other, and so there's no impairment. But if you're on the fence, or if things are going sideways a little bit, then step 1, so-called step 1, would have to be undertaken, where you would have to go through more of a quantitative analysis. Now, it may sound a little self-serving, but really we observe time and time again that instead of wondering whether the step 0 would pass, it may be a lot faster and cheaper to just run through the small calculation for step 1. And so that small calculation would immediately show in quantitative terms to your auditors or whoever reviewing this work that no, there was no impairment. Now, for goodwill impairment, one has to keep in mind that goodwill tested on a reporting unit basis. In other words, it's not your acquisition may fail next week, but if that acquisition was relatively small compared to the overall reporting unit that acquired that company, then they may not have any impact on that goodwill whatsoever, so it'll just stay on the books. And the third point, kind of a tip to have here, is that, again, going back to 498 evaluations, if you have a good substantive 498 report, then you can use it to support your goodwill impairment analysis. In other words, in the goodwill impairment analysis, you have to determine first the fair value of a company's equity and compare that fair value to the book value of the equity. So the substantive 498 report would actually give you that fair value of the equity. And you can use that, so you can play with timing here, or just combine kind of those two projects, obviously, and do it relatively cheaply, as opposed to do those two things separately if they disconnected in time. Where impairments may depend upon how well the acquisition is performing is when you look for individual intangibles that were assumed in those situations. And so let's say you acquired a customer relationship intangible and that acquisition failed, then that intangible would be written off, or most likely tested for impairment and written off or written down. And so this is where it's really important to keep consistency with your original purchase price allocation analysis. In other words, you would typically in those situations go back to the valuation specialist and ask them to run the model as of the new date, and do first step one, which is recoverability test, where you actually measuring the total amount of cash flows this asset will now generate given all the adverse developments, but on undiscounted and before they affected with tax expense. So on those bases, you're actually getting rid of two significant factors. And so if you get that total number of incomes actually that you will generate from that intangible, if that's still below your amortized amount of intangible, because you've always been amortizing that intangible, by the way. If you fail at step one, then you have to go to step two, and then you have to look at the actual fair value. So the reduction would be pretty substantial. Now, other portions where the purchase price allocation sort of lives on is obviously, as I mentioned, contingent consideration or the earnout that's marked to fair value, but then any type of non-operating assets, so let's say portfolios that you acquired, the financial institution might have acquired, let's say bank and their portfolios. So those portfolios would have to be be tested. Now, let me start this, our last polling question. And so, what are the best ways to avoid future goodwill impairment? So, correct. Three answers out of four here would work. So negotiating low purchase price will absolutely help you with that, because you'll just end up with less goodwill and less book value on your balance sheet. So it'd be easier for fair value of your equity to be higher than that. Now, using conservative forecast is also something that may be helpful in that regard, even though we talked about how forecast has to be sort of mildly optimistic forecast. Conservative forecast is typically where you go first to determine whether there is an indication of impairment. So if you're meeting the forecast, then everything is fine. But if you're missing the forecast, then the question arises, especially for intangible assets that were acquired, whether there has to be this type of impairment consideration. Now, buy only entities that are much smaller than acquiring reporting units. So that's another one. As I mentioned earlier, the goodwill impairment analysis is done on the reporting unit basis. And so if you have $1 billion reporting unit that acquired $5 million entity, then it's really unlikely that the performance of that $5 million entity will negatively affect the performance of the overall reporting unit. Now, overall reporting unit may tank, but that would be the only scenario where you get rid of that goodwill. But your whole acquisition may, disappear or dissolve next month, but you would still have that goodwill on your balance sheet forever. So let's go to the last slide. Essentially, what are the strategic takeaways from the purchase price allocation analysis. It's interesting because a lot of this, it talks about the economics of the overall transaction, but then this work is being done after the purchase agreement been signed. And so we do have clients come back to us and talk to us about this work, but before they start thinking about the next acquisition. So obviously the internal rate of return is something that can be indicative of what kind of discount rate they can use or should use next time they value a particular transaction. So they look, let's say we did the purchase price allocation for company A, now they want to acquire company B, what kind of discount rate they should use? Well, the purchase price allocation report can give you some ideas about that. Now, also, all the work that you do about the financial forecast can be incorporated in the future valuation policies. So, in other words, this is a very much iterative process. And so we go back to the management and we ask for different forecasts. We ask to adjust it for all those factors that would make that financial forecast applicable or appropriate for pricing purposes. And again, 75% of the time, we suggest adjustments to the forecasts that clients provide to us. So kind of documenting those steps and understanding how those steps really affect the value that the company is trying to receive from the next acquisition, all those elements can be incorporated into the valuation or forecasting policy for your next acquisition. So right there, you can look at the discount rate and the forecast, and those two factors will definitely give you pretty solid standing in terms of you applying discounted cash flow analysis for your next pricing exercise. Now, we hear this a lot in a lot of, we hear this a lot where I say that, well, the transaction was priced, it was negotiated. You know, and so because it was negotiated, like, why worry about the forecast? Why worry about all those things? Well, when transaction is negotiated, it's actually not a good answer. I mean, yes, it's the reality, but you certainly have tools and leverage to kind of guide your own reality. If you don't do the actual, quantitative analysis of that future acquisition, how do you know where to negotiate? I mean, what's your walk-away point? You know, what price is good, what price is not good. I have to say that quite frequently we see the financial forecast that just doesn't give us a high enough internal rate of return. I mean, we can still prepare the report that will pass the audit review using sort of all the common tools and methods, but that's just accounting. I mean, you really want to go into your next acquisition and make sure that you have, you know how much more, how much you're willing to pay and how much you're not willing to pay. And so really this type of analysis, however subjective it may appear, but if you can't dream up the cash flows that would be required to justify that purchase price, that's usually the place where you should stop the negotiation. Now, another part that's also very interesting, a lot of times when we get into this project and we start talking to management, we start talking to their, R&D or sales and marketing teams to get assumptions for our work, we have to really disclaim the fact that we're not doing any kind of backdoor due diligence here. It's a purely accounting exercise. So in other words, don't worry about it. Nobody's going to get hurt. Because what we ask for, really the types of questions that you should be asking prior to acquisition has been completed. For example, we routinely calculate customer attrition rate based on historical customer revenues. And so I can't tell you how many times, I mean, probably majority of the acquisitions, this data is not ready for us to work with. In other words, management has not looked at customer revenue. And oftentimes it's a service type business. So if it's a service type business, what else there that matters more than the customer attrition, historical customer attrition? And by the way, you have to model away the fact that you'll probably lose some customers because of the change in control. So we do a lot of that analysis, and I'd like to think more savvy clients ask us to look at those things prior to the transaction close. So it's kind of part of our due diligence package. The same thing goes about technology. So very often we hear, well, we made this acquisition for the sake of acquiring technology, but then somehow goodwill ends up being 70% of that acquisition. And so again, you have to understand that what's acquired is going to disappear in 3 or 4 years. And so are you really willing to pay the full enterprise, standalone enterprise price for something that, few of your engineers can, develop in the next year or so? And so again, very interesting issues that should be raised, in my view, prior to acquisitions and in the view of some of our clients. So we're certainly always happy to talk about this. But I would say that in addition, we certainly get involved in those projects prior to the transaction close, early due diligence, early purchase consideration and pricing of the transaction. Will, like I said, do the customer and technology relationship type work. We also help clients with quality of earnings with our partner, and we obviously do all the after closing activities. So really cover the full life cycle of that acquisition for our clients. So with that, this is the last bit of information here, and you can request a presentation from me, and I'd be happy to send it. Or just hit a screen capture here. So those are some of the numbers, some of the allocations you'll find in different industries. We actually have our own detailed database that goes in much more detail. So with that, okay, so I see one question here. Oh, actually, I see two questions. Yeah, so what about tax implications? Now, tax implications under US tax, all of the excess consideration, regardless of what type of intangible is it, goodwill or technology, it all gets amortized over a 15-year life. So what we do doesn't really have a direct relevance to your US tax in any way, shape, or form. Now, where it does matter is when the acquisition that you make is of a foreign entity. So it could be a foreign entity, or it could be number of legal entities, and you need to push down those intangibles to different legal entities. And you may also have to push down goodwill as well. So that's where our valuations are often used in a transfer pricing context, and it's used in the context of how you would move those intangibles across various jurisdictions. In one recent situation here, the company was acquired and kept in a foreign jurisdiction, but then they kept developing that technology that we already valued. So there right away, there is a need to revalue that technology at the time they will actually transfer it back to US. And that's their intent, but there's a good a year or so in difference. So there are definitely tax leverage that you get from this report, but it does not affect your US tax directly. So what are your greatest areas of focus for auditors? Yeah, so auditors, as I mentioned, they focus on the financial forecast in a big way. They focus on all the subjective assumptions. So how do you come up with the life of the technology? How you come up with the technology migration curve? How do you come up with attrition rate for customer relationships? How did you select your methodologies for earnout calculation? So those are typically the areas that are areas of subjectivity is where auditors will spend most of their time.